If you're running a business, you've probably wished for crystal ball, right? If you could just know exactly how many customers were going to walk through the door, you could make perfect decisions every single time. But obviously, that's not how it works. So how do you plan for a future you can't see? Well, today, we're going to dive into the next best thing, a seriously powerful financial tool that acts as a kind of business crystal ball. So here's our game plan. We'll start with that big challenge every business faces. Then we'll break down the basic pieces of profit. After that, we'll use those pieces to figure out not just how to survive, but how to actually thrive. We'll even look at managing risk and, finally, cover the really important assumptions you've got to keep in mind. I mean, this is the question, isn't it? Just imagine you're running a restaurant. You have to schedule your staff, you have to buy all the ingredients, pay the rent, and you do all of that before you have any idea if 10 people are showing up for dinner or 100. If you guess wrong, you lose money. So how do you find that magic number, that exact point where you're not losing money anymore? And that is exactly where our financial crystal ball comes into play. It's a framework that lets you answer all those critical what-if questions with some real confidence. It works by showing you the direct relationship between three key things: what it costs you to run your business, how much you sell, and, of course, the profit you make at the end of the day. Okay, so the official name for this tool is Cost Volume Profit Analysis, or just CVP. It's a fantastic method that really zooms in on sales volume. Because let's be honest, in the short term, that's the biggest unknown, right? Your prices are kind of set, your big costs are pretty predictable, but sales, that's the wild card that can make or break your entire month. All right, so before we can start making any predictions, we need to get a handle on the basic ingredients that CVP analysis works with. Think of these as the fundamental vocabulary of profit. Once you get these down, everything else just clicks right into place. First up, you've got fixed costs. These are the expenses you have to pay no matter what. The classic example is your rent. Whether you sell a single thing all month or you have a line out the door, that rent check is the exact same amount. It's fixed. And then, on the other side, you have variable costs. These are tied directly to every single sale you make. So if you run a coffee shop, the cost of the beans, the milk, the paper cup for each latte, that's a variable cost. The more coffee you sell, the more you spend on those things. Simple as that. Now, this brings us to a concept that is absolutely crucial: the unit contribution margin. It's so important to get this right. This is not your final profit on an item. It's the little bit of money each sale generates after paying for its own variable costs. This is the cash that's left over to contribute to paying off your big fixed costs, like rent. And only after all of those are covered does this start to build your actual profit. So to make this a little more real, let's meet Company A. They sell a product for $50. It costs them $30 in materials and labor to make each one. So you just subtract that, and you get a unit contribution margin of $20. And their total fixed costs for the year, think rent, salaries, all that stuff, comes to $200,000. Keep these numbers in your head because we're going to use them for the next few slides. Okay, with those building blocks ready, we can now chase our first big goal: finding that break-even point. This is the absolute baseline for survival. It's the precise number of sales you have to hit to cover every single one of your costs. At this point, you're not making any profit, but, and this is key, you're not losing any money either. Now, there are a couple of ways you could calculate this. You could set up a big, long profit equation, or you can use a more direct shortcut. We're going to focus on the contribution margin method because honestly, it's cleaner, it's more intuitive, and it really shows you how each sale is chipping away at those big fixed costs. The logic here is just beautiful. It's so simple. We already have our two key numbers, right? Step 1, we know the big mountain of fixed costs we need to climb. Step 2, we know how much each sale helps us climb. That's our contribution margin. So step 3 is just basic math. How many steps does it take to get to the top of the mountain? And here's how that simple logic looks in one clean formula. To find the number of units you need to sell to break even, you just take your total fixed costs and divide it by your unit contribution margin. So for our friends at Company A, that's $200,000 divided by the $20 each unit contributes. And there it is, 10,000 units. That is the magic number for Company A. If they sell 9,999 units, they've lost money. If they sell exactly 10,000 units, they've paid for everything: the materials, the rent, the salaries, and their profit is exactly zero. Every single unit they sell after this one is pure profit. But let's be real, businesses don't aim to just survive. They want to thrive. So what happens if Company A has a specific profit goal in mind? Let's say they want to make $300,000 this year. Well, CVP analysis makes this calculation just as easy. We use the exact same logic as before, but with one tiny little addition. We now think of our goal not just as covering our fixed costs, but as covering our fixed costs plus our target profit. We just add that profit goal right into the top of the fraction. It's the total financial mountain we now need to climb. So for Company A, that's their $200,000 in fixed costs plus their $300,000 target profit. That's a total of $500,000 they need to generate. You divide that by their $20 contribution margin per unit, and you get a brand new target, 25,000 units. Just like that, they have a clear, actionable sales goal that is directly tied to their financial dream. Okay, but the real world is rarely as simple as selling just one product, right? Businesses need to understand risk. They need to manage more complex stuff. And CVP analysis has tools for this too, which lets us add some more realistic layers to our financial map. First, let's talk about risk with something called the margin of safety. This is basically your buffer zone. It answers the question, how bad can things get before we're in real trouble? It's the gap between what you expect to sell and what you need to sell just to break even. And a bigger margin means a whole lot less risk. So let's imagine Company A is budgeting to sell 20,000 units. We already know their break-even point is 10,000 units. That means their margin of safety is a full 10,000 units, which gives them a very healthy 50% cushion. Their sales could literally get cut in half before they hit the danger zone. Now that is a powerful piece of information for any manager to have. But what happens when a business sells more than one thing, which, let's face it, is most businesses? Here, Company A adds a second product, Product Y. The problem is, we can't use a single contribution margin anymore. So the solution is to calculate a weighted average contribution to sales ratio. Now, that sounds complicated, but just think of it this way. It averages out the profitability of your entire product mix. That final number, about 34%, tells us that for every single dollar of revenue the company makes, across both products, about 34 cents is available to cover fixed costs and then generate profit. That single number lets us calculate a break-even point in total sales dollars, which is absolutely essential. CVP analysis is an incredibly useful tool, but it's a model, not a magic 8-ball. And to use it wisely, you have to be aware of the assumptions it's built on. Honestly, knowing its limits is just as important as knowing how to use the formulas. So here are the big ones. CVP assumes that costs are either perfectly fixed or perfectly variable, which isn't always true in the real world. It assumes your selling price and your cost per unit don't change, which ignores things like getting bulk discounts. It also assumes your sales mix between different products stays the same. Now, these assumptions usually hold up in the short run, but it's crucial to remember they are simplifications of a much more complex reality. So, no, CVP analysis can't perfectly predict the future, but it does give you an incredibly powerful map. It lets you explore all kinds of different scenarios, set goals that actually mean something, and understand the real drivers of your profit. It turns those vague worries into specific questions you can actually answer. So the only question left is, what's the first financial question you're going to tackle?